Good morning, ladies and gentlemen, fellow speakers, and good morning to our audiences joining us online from around the world. Firstly, let me introduce myself. My name is Yulita Kusumaningrum, and I am here today to talk to you about overinvestment, debt, dividend policy, ownership structure, and firm performance, empirical study in Indonesia. There are three important financial policies, namely debt policies, dividend policies, and investment policy. The presence of an imperfect capital market, such as taxes, transaction costs, liquidation costs, and asymmetric information, has an impact on investment policy originating from debt and dividend policy. The strategy related to investment decisions determines the profitability that will be obtained by the company in the future. A manager acts as a company agent who has the duty to allocate capital resources so that they can achieve optimal investment levels. However, in practice, there is often disharmony between agents and principals, or in this case, is a company from implementing company goals. However, in practice, there is often disharmony between agents and principal, or in this case, as companies in implementing company goals. So, in order to get as much personal gains as possible, managers tend to expand their financial holdings under their control. This is certainly the contrary to the goal of shareholders, which is to maximize profits. In this case, managers tend to invest in projects with a negative NPV, which indicates an agency problem within the company. So the way to overcome the agency problem is to use debt in the capital structure and pay dividends, as well as the existence of institutional ownerships in the company. From the research background before, we can conclude that there is a dependence between debt policies, dividend policy, and investment policies, as well as institutional ownership within the company. Research by Farouk in 2014 and Trong in 2020 proved that overinvestment has a negative effect on the company performance, while research of Jiang in 2019 proved that debt policy can help to reduce overinvestment problem in the companies. Research by Wei in 2018 also proves that dividend policy can reduce overinvestment problem. Furthermore, research by Wei Chow et al. In 2018 proved that the existence of institutional ownership in the company can influence the company investment decisions to become efficient investment. However, there is a difference in the results of the study conducted by Tumba in 2021, who found that overinvestment has a positive effect on the company performance. For the research objective, this study aims to identify the impact of overinvestment policies on the company performance as measured through the company profitability. In details, there are four objectives of the research. Firstly, to examine the effect of overinvestment on the company performance. Secondly, to examine the effect of debt policy in moderating the relationship of overinvestment to the company performance. Thirdly, is to examine the effect of dividend policy in moderating the relationship of overinvestment to the company performance. And lastly, is to examine the effect of institutional ownership in moderating the relationships of overinvestment to the company performance. This research is carried out to provide empirical evidence supporting previous research, especially from the perspective of the non-financial companies in Indonesia. For the literature review, firstly is overinvestment. The conflicts of interest arise from differences in ownership between shareholders and management, which manager who comprehensively understand their internal operations decide to benefit themselves with higher salaries, promotions, and property under their control. And such a fundamental motivation explains overinvestment well. Secondly is company performance. The study refers to the accounting reports by measuring company performance using profitability ratios. According to Brigham, profitability ratios are a group of ratios that show the combination effect of liquidity, asset management, and debt on the company operational results. Next, the policy can make manager performance monitored by external parties, namely creditors. And manager can improve their performance to align with the interests of external parties. Next is dividend policy, which can reduce stock raise. If the company retains profit and does not distribute dividends, stock raise will increase because the company's management may implement policies that are not necessarily beneficial to the shareholders. Next, institutional ownership will play an important oversight role in reducing the agency costs, precisely in voting board relating to important decisions that will be taken by the company. Institutional ownership act as a strong oversight body to prevent the bad investment problems from occurring in the company. For the hypothesis development, firstly, some research literature shows a negative relationship between overinvestment and the company performance. Trong in 2020 and Farouk in 2014, as well as Liu in 2021, found that the overinvestment have a negative impact on the firm performance in the company located in Vietnam and Singapore. So in this case, the company has a lower investor monitoring and higher agency fees. Thus, the first hypothesis in this study is overinvestment negatively affects the firm performance. Secondly, debt issuance has an important role in disciplining managers to control free cash flow. Myers in 1977 explained that the use of debt can overcome the problem of overinvestment, which can result in the company's value. In the research of Trong in 2020, debt is also proven to reduce the negative influence of overinvestment on the company. Thus, the second hypothesis in this study is debt policy can weaken the negative effect of overinvestment on the firm performance. Next, high dividend payment can prevent managers from committing unreasonable actions and wasting the free cash flow. In addition, high dividend payments will also limit the extent to which manager can take over shareholders' wealth due to the small amount of the cash available. Lang in 1989, found that the decrease in the overinvestment could increase in the company's value by increasing dividend payments. Thus, the third hypothesis in this study is dividend policy can weaken the negative effect of overinvestment on the firm performance. Lastly, the active involvement of the institutional investor in corporate portfolio governance influence managers' decision-making. This is because institutions have more straightforward access at a lower cost in obtaining information, so companies benefit in the market. Hence, institutional investors play an important role in overseeing the process of reducing agency costs. Thus, the fourth hypothesis can be formulated as follows, which is institutional investor or institutional ownership can weaken the negative influence of overinvestment on the firm performance. The study used the secondary data, which is the financial statement of the company listed on the Indonesia Stock Exchange. The financial statement used is the financial statement reported from 2011 to 2021. And the data needed in the study includes the company investment expenditure, current assets, company share price, total cash, current debt, total asset, EBITDA, inventories, which obtained through Thomson Reuters Econ or Refinitiv Econ and Custodian Central Efek Indonesia or KSEI. And the study used the combination of time series and cross-section, which we call pooled data. For the sample, the study used the specific criteria to provide a complete information, which include, firstly, non-financial companies listed on the Indonesia Stock Exchange and conducted an initial public offering or IPO in 2011. And secondly is the company shall have the publication of a complete annual financial statement. And third is the company distribute dividends in the period of 2011 until 2021. And lastly, the company had debt in the period of 2011 until 2021. Based on this criteria, the number of samples are 55 non-financial companies in Indonesia. Definition of operational variables. So this research used firm performance as a dependent variables, which measure through three proxies, namely return on assets, basic earning power, and net profit margin. For the independent variables is overinvestment, which is the positive residuals of investment equation, or I use the dummy one. For the moderation variables is debt, dividend, and institutional ownership. And this research also use control variables such as firm size, sales growth, business risk, and liquidity. Basically, there are 7 empirical model, and this research used the moderated regression analysis. So there is several steps to do the regression, as we can see in the presentation. Next, the results for descriptive statistics, which the sample obtained is 605. Next is the classic assumption test. For the normality test, all regression models are not normally distributed because the probability value is less than alpha, which is 0.05. So, but according to Palan in 27, the assumption of normality does not cause major problems in the study with a sample size of more than 40. So next is the heteroscedasticity test, which 16 of the 21 regression model shows heteroscedasticity problem because the p-value is less than alpha. But this problem is solved by the generalized least square or GLS method to maintain the normal assumption because this method takes into account the heterogeneity of the regression equation. Lastly is the multicollinearity test, which there is no correlation coefficient value above 0.9, and there is no multicollinearity in the independent variables. Next is for the results for hypothesis 1, which is overinvestment negatively affect the firm performance. So the overinvestment coefficient consistently have a negative value on all company performance and have a significant effect at the alpha values of 10% and 5%. So it can be concluded that overinvestment has a negative effect or influence on the company performance. This is because overinvestment or excess investment causes an inefficient spread of investment assets. And overinvestment also occurs because managers make investment decisions that are not optimal with the aim of maximizing their personal returns. Secondly, results for hypothesis 2, the moderation of the policy and overinvestment has a positive and significant effect on the two proxies of company performance of return on assets and basic earning power. The policy can weaken the negative effect of overinvestment on company performance because companies are required to pay interest and loan principal, which makes manager more disciplined in making investment. The negative coefficient of debt indicates that when a company has a lot of debt in its capital structure, the company is faced with a high rates of bankruptcy when something out of control occurs, such as disaster, war, or recession. Next, for the moderating relationship between dividends and overinvestment, show a positive coefficient on the three proxies of firm performance with an alpha significance level of 5% and 10%. Dividend policy can mitigate the negative effects of overinvestment because dividend can help to reduce excess cash with better outside monitoring. Dividend coefficient, the negative one, indicates that if the company pays too much dividend, the company will lack of fund to invest in the profitable projects. Next, for the fourth hypothesis, the institutional ownership or the moderation of institutional ownership and overinvestment has a positive and significant in both proxies for company performance. Institutional investors play a role in the monitoring process and can influence manager in making important decision in improving the company's financial performance and investment efficiency. So the active involvement of institutional investor in corporate portfolio governance influence manager decision making. But there is also a negative coefficient of institutional ownership, which indicates that a lack of coordination or communication between institution and the company. For the conclusion, to recall, the research purpose is to examine the effect of overinvestment on company performance and examine the moderation effect of dividend, debt, and institutional ownership. The research result concluded in 4 parts. The first is overinvestment has a negative effect on the company performance, return on assets, basic earning power, and net profit margin. And next is the policy can weaken the negative effect of overinvestment and the company performance. This is because debt can discipline the behavior of managers to be wiser in making investment. Thirdly, dividend policy can weaken the negative effect of overinvestment on the company performance. This is because the dividend policy can reduce the company's free cash flow, so that the investment opportunities will be limited to profitable projects only. Fourth, the institutional investor exists within the company can weaken the negative effects of overinvestment, which cause the company to have a poor performances. This is because institutional investors have an active role in increasing supervision of the manager. Next, for the limitation of this research, firstly, this research is only measured company performance by the financial performance. Secondly, the study is only measured for investment indirectly through the investment demand function developed by Richardson in 2006 and modified by Trong in 2020. And the data in this sample are limited to the companies that made IPO in 2011 and have a complete financial reports until 2021. Industry variables are not used as a control variables in the study. Further research can consider several suggestions, including first, measuring company performance using market performance proxies as a form of consistency of the results. Second is to use other alternatives to measure overinvestment and compare the result with the study. Third is to use a larger sample of the companies, and fourth, the research can be specifically differentiated based on the certain type of the industry. Thank you. That's all I can present. Thank you for your attention.